Inside the Law is presented to educate listeners in Monmouth and Ocean counties about legal issues. The opinions expressed by the host, guests, and phone callers are strictly their own and do not necessarily reflect those of Town Square Media and are not intended to be a substitute for personal legal advice from your own attorney.
Your questions and comments are welcome at 732-505-1160. Inside the Law, talk radio for the Jersey Shore.
Good morning, Monmouth and Ocean counties, and good morning to the rest of the world listening out there on the internet. This is attorney Jason Wyatt from the law firm Novy & Associates. Novy & Associates is a boutique law firm. That does not mean we sell dresses. It means that we are specialists, and our practice focuses in the area of estate planning, estate administration, elder law, asset protection, Medicaid planning, and guardianship. We also do litigation in each of those categories. Today, we are hosting Inside the Law live on 1160 WOBM AM in Ocean County and on 1310 AM in Monmouth County and all over the world on WOBMAM.com. You know the format of our show. Every show, we take you inside the law to learn about an issue or topic of interest that relates to our practice of the law. Today, we have a guest, Chad White from Safe Harbor Wealth Management. Good morning, Chad.
Good morning, Jason.
Safe Harbor Wealth Management is Chad's investment firm. Their website, if you want to check them out while we're on the air today, is safeharborwm.com. The WM as in wealth management. LPL Financial is Safe Harbor's broker-dealer. They are the largest broker-dealer, independent broker-dealer in the nation. And we're happy to have Chad on. Chad has 20 years of experience in the industry. He has a CIMA designation. Chad, remind me what CIMA stands for?
Certified Investment Management Analyst.
So he has a CIMA designation from the Wharton School of Business at the University of Pennsylvania, and he is an accredited fiduciary. Chad, do we have some housekeeping, FINRA type stuff to get through here at the beginning?
Sure. We always have disclosures whenever we're talking about finance. So our disclosure is that I'm a registered representative with and securities and advisory services are offered through LPL Financial, members FINRA and SIPC. Any insurance products offered through LPL or its licensed affiliate are not FDIC insured, bank guaranteed, or anything else. And nobody should take anything that we say on this show as any kind of an investment recommendation of any kind. They should always consult with their own financial advisor before, or CPA or whoever, accountant, attorney, before making any investment decisions.
Not this attorney.
You don't make investment recommendations,
absolutely
huh, Jason? You
not.
don't go outside your profession?
I leave that to the pros like you, Chad. Today's topic is one that a lot of clients have questions about, and we're going to call it investing in stocks, which is a broad topic to try to handle in an hour. But we hope some of you will listen and have some questions, because we know not everybody, but a lot of people follow the stock market. They think about stock as maybe the primary type of investment, because it's the one you hear about on TV and in the news, and what's happening to the various indices and averages in the stock market is basically standard part of the nightly news, like weather. So today we're going to try to handle some components of that. If you have any questions today while we're on the air, feel free to either give us a call at 732-505-1160. Again, that's 732-505-1160. Our sound engineer today is Paul. He'll be happy to take your call. Or if you prefer, you can call us and get in touch with us during the week. 732-657-0600 is our number at Novy & Associates at the law firm. Or you can give Chad a ring at Safe Harbor at the number 732-364-2045, and I will repeat those numbers later on in the show. Components of today's show that we're going to discuss under the umbrella heading of investing in stocks include the concept of diversification, a common buzzword within the industry. You see it on commercials on TV. But what does it really mean? Chad certainly is going to be able to explain it to us in detail, especially because there are actually varying differences in what it means. And we're also going to talk about the discussion of the difference between yield and return, an important distinction, as well as a concept, a little bit higher level concept, but it's not super complicated, called dollar cost averaging, which I think is important for any armchair investor to have an understanding of. And we may go other places as well, wherever the conversation takes us, wherever the questions take us, and so forth. So the basic format for today is I'm gonna play the role of a beginner or neophyte who doesn't know much about investing in stocks, which isn't going to be a hard role for me to play because I usually tell my clients I know just enough to get me in trouble, and if if you start asking me any real questions, I'm going to have to defer to a pro like Chad, and Chad's going to answer the questions, and we're going to have a discussion of some of these important subjects. So the first one that I'm going to ask, it's that that diversification concept. So Chad, just tell us in your words, what does diversification really mean when it comes to investing, and especially investing in stocks?
Well, since we want to talk about and go back to the basics of talking about stocks, let's first just talk a little bit about what stocks are and what they are not. Mm-hmm. Stocks are, well, what people say they are is part ownership in a company or a corporation. Mm-hmm. And so let's say that, for example, I own stock in UPS, United Parcel Service. Mm-hmm. And I'm driving over here to be on the radio show with you. Right. And my car breaks down. And I'm at the Wawa when my car breaks down, and the UPS driver is there with his truck, and he's inside delivering packages, and he leaves the truck running. Mm-hmm. Does that mean that since my car broke down and I'm part owner of UPS because I own their stock, I can just hop in the UPS truck and drive over here to the radio station and come on the show?
Sounds like fun, but I bet that's not the answer.
No. And the reason why you can't do that is because when you buy stock, it's not actually that you're part owner of the corporation. What you're part owner of is the corporate earnings. So companies earn money, and then they divide their earnings by the number of shares outstanding. And so what you'll hear them talk about, if you ever put the TV on to the news and they're talking about stocks, you'll hear them talking about earnings per share. Mm-hmm. And so that's the share of earnings that you get, and the more shares of stock you get, the larger percentage of the corporate earnings you participate in. So that's really what stocks are, is a percentage or a share of the corporate earnings. And then to talk about diversifying, whenever we invest in stocks, I mean, why do we want to invest in stocks in the first place? The market seems kind of volatile.
Sure.
But over the long run, historically, the market has risen. I mean, if we go back 10 years, 20 years, 50 years, the market is a lot higher now than it was then.
Right.
And stocks are one of the things that can help us to potentially keep pace with inflation. And why is that? Why can stocks help us keep pace with inflation? Well, if you think about a stock or a company like Coca-Cola, if the cost of sugar and whatever the other ingredients are in Coca-Cola are going up, if those costs are going up, what are they going to do? They're going to raise the cost of Coca-Cola. And so if you own stock in Coca-Cola, you're going to participate in that. So as things are becoming more and more expensive, companies are raising their prices, and if you own shares in that company, you're going to get a share of their earnings, and their earnings are going to be higher if they're raising their prices because the costs of things are going up. I mean, think about how much a car used to cost 20 years ago. I mean,
anything for that matter.
Anything.
The price of gas is one that my clients always talk about.
Yeah.
It's just.
I mean, it's amazing now. It's
crazy.
amazing now the way we talk about money. Mm-hmm. I remember years ago, $1 million or talking in terms of millions, what was really hard to even imagine how much money that is. $1 million, that's a lot of money. And, for people maybe living in Manhattan now, there are a lot of apartments in Manhattan that sell for over $1 million.
Sure, absolutely.
You know? And the way we think about money now is so much different than it was years ago. I mean, the state of New Jersey has billions of dollars in debt. Billions. I mean, we used to talk about the federal government having billions of dollars in debt. Now the federal government has trillions of dollars in debt. Mm-hmm. And we teach classes, you and I, at Ocean County College. And one of the things I ask the class oftentimes is I say, how much is $1 billion? Because a lot of people, most people don't even think about it. They don't even know how much $1 billion is.
Mm-hmm.
And, you know, people will say, well, it's 100 million. Well, it's not 100 million. It's 1,000 million.
Mm-hmm.
1,000 million, which is really hard to imagine.
Yep.
And then we talk in terms of our government's debt, $18 trillion, and a trillion is 1,000 billion. I mean, it's unfathomable. So when we talk about stocks, when we talk about investing, and we talk about diversification, I got off course there a little bit.
That's the point of today's show. We go where the conversation takes us.
But a simple example is if you own two stocks and one falls in value by 50% and the other one stays the same, the overall value of the portfolio has fallen by 25%.
Right.
However, if you own 10 stocks and one has a 50% drop in value and the others stay the same, the portfolio has only suffered a 5% loss. That's one of the freebies in investing is diversification. It's kind of rule number one, diversify, 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 because what you can accomplish is in your portfolio is you can completely do away with what's known in the industry. The official term when you go to Wharton is called non-systematic risk. Non-systematic risk is the risk that you own or you have all your money in Enron or WorldCom and it goes to zero.
Right.
So you can instantly take that one risk, the risk that you have all your money in one stock and that stock goes to zero. You can instantly take that risk off the table or out of your portfolio simply by diversifying. So that's one risk that we can do away with. But the risk that we can't do away with is systematic risk, which is market risk.
Which is the Great Depression, a huge stock market or economy collapse or something like that across the board.
And people don't realize how much the stock market went down during the Great Depression, how much the Dow Jones Industrial Average went down, and how many stocks are on the Dow. The Dow has 30 stocks, and the Dow is a price-weighted index. So the higher the price of the stock, the heavier the weighting is in the Dow. Most of the stocks that were on the original Dow 30 are all gone. I think the only one that's still on there is GE maybe. But most of the other ones have either merged with other companies or gone out of business,
right.
U.S. Steel and companies like that. So U.S. Cotton. I mean, we don't have those kind of companies anymore.
The economy has evolved.
It certainly has. And so the stock market, talking about the Great Depression, the Dow Jones Industrial Average went down 85%. Can you imagine?
In how many days? 1 day, 2 days?
No, it didn't happen overnight.
Okay.
The market started to drop in 1929, and it didn't hit bottom until 1932.
Okay.
So it took a few years. But if you had invested your money in the market in 1929...
Bad timing.
Bad timing. And how long did it take for you to get back to even?
I know that I've heard this before. It's not quite as long as some people think, but it was a long time.
It's a long time, 25 years.
1955.
Okay. You got back to even. If you had your money invested in the Dow.
Because that's how long it took.
For the Dow to get back up to its previous level.
Well, more than that, right? Because if you
lose 85%, you got to make more than 85%.
You need like 170% before you're back to even, right?
That's one of the things
that
we talk about,
Yep.
and I just wrote an article about that just got published on the Paladin Registry this past week. I just wrote an article about the difference of investing while you're working as opposed to when you're retired. People need to look at retirement as I'm going to be unemployed for the next 35 years. I mean, think about that. How much money is that going to cost? It's expensive.
Yep.
And what we've seen, Jason, is people who have been retired for a long period of time. in places like Holiday City, some of the older retirement communities, we've seen their standard of living go down. There's no question about it.
Sure.
Back when they retired, when Jimmy Carter was president, you can get a CD paying 16%. You can't get that anymore.
Right.
And so their income has dropped substantially if they had their money in CDs.
Yep.
But if they had their money in stocks, there's a possibility that they could have kept pace with inflation.
And unfortunately, people in retirement think, I've got to be conservative. I'm so conservative by nature. And they get to the point where they think stocks are off the table because they're not conservative enough. And they don't realize, and I think you'd probably agree, that you can mitigate, like you said, a lot of that risk with diversification.
With diversification and some risk management.
Right.
We were talking before about losses, and if you start with 100,000 and you lose 50%, how much do you have to make to get back to even?
You've got to.
We asked that question in our class.
I love this example. So if you follow it through, you start with 100,000, it goes down 50%. You've got 50,000 left. Now the stock market or your portfolio went down 50%. If it goes up 50%, how much do you have? And you'll probably know a lot of people will say, well, I'm back to even then. And the answer, if you run the math, is no, you're not back to even. So if the stock market can't just go up and down by the same amount for you to get back to even, because with your 50,000, if the stock market goes up 50%,
50% of 50,000 is 25,000.
So you're at 75,000. You are still 25% behind where you started.
And think about it. If you just do the math, and you're an investor and you say, okay, I had a negative 50% return the first year and a positive 50% return the second year, so my average rate of return is 0.
Right. So it feels like you should be even.
It feels like you should be even, but you're not.
Right.
And so that's one of the things we talk about in class, because one of the things that can hurt you in retirement is something called the sequence of returns. And if you have negative returns in the first 5 years after you retire, or in the previous 5 years right before you retire, if your account drops significantly, it can be very difficult for your account to recover because of what Jason and I just talked about. You have a big loss. People don't realize. If you have a loss, and I know the numbers because I just wrote this in my article, if you're in the accumulation phase, so you're not taking out distributions out of your investment account, and you lose 30%, in a bad market, let's say 2008 or 2000 to 2002, which were two bad markets, what we call bear markets,
right,
as opposed to a bull market, which is a good market, a market that's going from the bottom left to the top right. That's a good trend.
Right.
A market that's going from the top left to the bottom right, that's not something we want to see.
Right.
And that's a bear market. And when we're in a bear market like that, if you lose 30% of your account value, which a lot of retirees did in 2008,
sure,
a lot of people lost 30%.
Yep.
If you're not taking out any withdrawals, you need to make 43% to get back to even.
Okay.
If you're taking out a 4% withdrawal each year, you need to make 63% to get back to even, because of that extra 4% draw on the account is like compounding in reverse.
It's going to say exactly, because the base is smaller, so you need a greater rate of return in order to break even, because you're pulling money out of the base. The principle.
What we say is it's almost like dollar cost averaging in reverse, and that's one of the next things we wanted to talk about is dollar cost averaging. And I'll explain dollar cost averaging in a minute, but And you need to make that 63%, Jason, in 3 years. If you make 63%, but you make it in 4 years, you're still not back to even.
Right.
And a lot of people saw, even with the stock market rising pretty dramatically since 2009, a lot of people's accounts, just this past time when the market went down, a lot of people's accounts didn't get back to even until 2012, 2013.
Right. Took a long time.
And we saw the NASDAQ go down significantly in 2000 with the tech.com bubble burst. And that was a result of a lot of investors not being diversified.
Right.
A lot of investors had all their money in .com stocks and tech stocks in the late 90s.
Right.
Why would you buy Coca-Cola when you can buy a tech stock that doubles every 3 months?
Right.
And so we had a lot of investors who had all their money in tech stocks, And so they were not diversified. And when the tech stocks went down, they all went down together, And so there's an example of not being diversified, losing more than you should have. And the NASDAQ market, which has most of those tech stocks, went down in 2000 and didn't get back to where it was until in 2000 until a year or so ago. I mean, it just recently eclipsed its value back 15 years ago.
Gotcha. It took that long.
It took that long.
So I think Chad's making a good point that I want to emphasize for our listeners. We have a kind of first basic definition of diversification, which is owning lots of stocks versus just a couple. And in Chad's example, he used the example of, if you only own 2 stocks and one of them goes down 50%, then the whole portfolio drops 25%. If you own 10 stocks and one of them goes down 50%, then the whole portfolio only goes down 5%, everything else being equal. That's diversification style number 1. Diversification style number 2, like Chad just talked about, is sectors. You can have 20 different .com stocks in 2000. You're not diversified from that definition. You're diversified from the first definition because it's not all in 1 or 2, but you're not diversified on that second definition because you're all in one sector.
Yeah.
So diversification across sectors to prevent, would you say a bubble? When you have a bubble issue or a stock market problem that's isolated to a couple of sectors, you're mitigating that risk?
Yeah, and we've seen it this year. I mean, this year we had a very big decline. Remains to be seen if it's going to rebound or not, quickly or not. But we had a very big decline in the biotech sector this year. So people who invested in the biotech sector maybe several years ago, they are still probably up because the biotech sector has gone up probably threefold in the last several years. But people who have invested in it just recently, if you put your money in the last 6 months, you had no choice but to make your account more conservative because the biotech stocks are down so much. But talking about diversification, it's not just like you said, it's not just multiple stocks, but it's also diversifying across market sectors. And there's all different types of sectors in the market. We talked about technology, banking, retail, consumer discretionary, which is all the stuff you don't need, consumer staples, which is all the stuff you do need, like toilet paper and food and things like that.
Right.
Consumer non-discretionary is things like Coach handbags, which you don't need, which, we know some women who might disagree with that. but they may think it's a necessity. But also diversification involves different asset classes. So maybe we don't want to have all our money in stocks. We want to have some money in bonds and other things that could possibly go up when stocks typically go down, and bonds tend to do that. They certainly did it in 2008, but most people owned the wrong kind of bonds in 2008 because Treasury bonds were paying such a low yield that people in 2008, a lot of people didn't own them. What did they own? Corporate bonds. Well, corporate bonds went down just as much as stocks, in some cases more than stocks. So they weren't really diversified when they thought they were. And I see cases all the time. Not too long ago had a gentleman come in with a portfolio that was very heavily overweighted in very high dividend paying stocks. And with the recent market volatility, he said, I've seen my account go down significantly. And I said, well, you have mostly high dividend paying stocks, and high dividend paying stocks, they all go up together and they all go down together. So you may want to look at some different types of stocks or different types of investments to really get your account diversified. So
it's a good way of pointing out this third definition of diversification, which is diversification across asset allocation, across different asset types. So you have that first type, which is owning multiple, not just 1 or 2, but a good number of different stocks, for example. You had diversification, which means different sectors. The guy you're just talking about might have accomplished both of those diversifications, but because he stuck with high dividend stocks, he didn't accomplish number 3, which is he didn't have maybe the diversification among different asset types. He had all one asset type, and because those asset types tended to go up and down together, he was not sufficiently diversified.
Sure. And, whenever you see a stock or bond paying a lot more interest than something else or than what the average is in the market, you have to understand something. There's nothing for free.
Right.
It's paying a higher dividend because there's more risk associated with it. Okay. People say to me, "Oh, well, what about this stock with this high dividend?" Well, you really have to do your homework, because if it's paying such a high dividend above other companies, it's for a reason. It's because that company's credit rating might be lower. It's because of numerous different things.
Right.
So, I remember years ago, I was a financial advisor at a large bank before I went independent and started my own company, Safe Harbor. And at the bank, we had something called preferred stock. Now, preferred stock isn't like Apple common stock. Apple stock is just using Apple, the company, as an example. You hope that you can buy it at $10 and you hope it goes to $200 a share. That's never going to happen with preferred stocks. Preferred stocks, numerous different companies offer them. But back when I was working at the bank, we noticed that WorldCom preferred stock was paying a much higher dividend than some others. And people invested their money in WorldCom to get that higher dividend. And WorldCom, preferred stock ended up going to zero. Mm-hmm. So, yeah, they got a high yield for a while until the company went to zero and they lost their initial principal investment, which is not the objective. So this is actually a good segue to our second bullet point that we talked about at the open. And once again, reminding everybody that you're listening live to Inside the Law on 1160 WOBM AM in Ocean County and 1310 AM in Monmouth County, and all over the world on WOBMAM.com. And again, this is attorney Jason Wyatt from Novy and Associates, a law firm, and we're here with Chad White. What would you like to call yourself, Chad? Do you call yourself financial advisor? Yes,
financial advisor.
Financial advisor
from Safe Harbor Wealth Management. And we're talking about the broad subject of stocks. And in our open, we talked about the difference between yield and return. And so we've just been chatting about the concept of high dividend stocks, which, correct me if I'm wrong, Chad, they entice people sometimes with a high yield, but that doesn't necessarily maybe accurately reflect what you should be looking at in the long run, which is maybe the return you get when you invest in them. So give me a little run through of the difference between yield and return, since we're kind of talking about it anyway.
Before we get off diversification, I wanted to just reiterate another story. That's okay. Absolutely. Because people love to hear stories. We know this from teaching our class at Ocean County College.
War stories, we call them.
People love to hear stories. Mm-hmm. So when when I first opened Safe Harbor, we were over on Route 9 for 10 years. And then now our office is right on Route 37 across from Community Medical Hospital. We're right in the Commons. And but a couple came to see me when I was in my old office on Route 9, and they had most of their money in GMAC preferred stock and bonds and GM stock, because the guy worked for GM. Mm-hmm. And they were with a big brokerage firm. And the guy heavily believed in GM, but we all know what happened to GM. And I said to him, you really need to diversify this portfolio, and he didn't do it. And he did not become a client of mine. And if he kept his portfolio the way it was and he didn't diversify it, he lost a lot of money.
Sure.
So that's just, you can have GM stock, you can have GM bonds, you can have GM preferred stock, and if GM gets in trouble, you're not really diversified there.
Sure. And what it points out, Chad, and I see this in my office a lot with when I'm doing estate planning with clients and they're showing me an asset picture, is that war story is a good example of somebody who, because he worked with the company, has a strong emotional tie to the investments.
Sure.
And you see that a lot with people. I've seen it with pharmaceutical stocks. We have a lot of pharmaceutical companies in New Jersey, so there are a lot of retirees out there who worked for their company like that. I see it a lot with some of the utility companies that we've had that have been tried and true companies in New Jersey for a long time.
And look at what's happened with pharmaceutical stocks just over the last 6 months.
It ties back into 30%. Your example. Yep.
On average.
And I see people come in and they're extremely deferential to the company. That will never, this company will never go out of business. They'll never have issues like that. And they're putting all their eggs in one basket. And they're rational people otherwise. It's an emotional tie they had because they worked for that company for 30 or 40 years of their life, and they believe in it, and they
a lot of times the stock has done well over all those years.
Right, and they've had decades of good performance, exactly. It's the only thing that it reminds me of sometimes are people when they refuse to sell their house. They know they need to sell their house, but they might even have it on the market, and then they will reject offers from buyers because they're too low, or it will get in a closing, we'll get past the initial components of it, and the buyer will have a home inspector come and inspect it, and the home inspector will list all these things that need to be repaired or replaced or fixed, and because of the emotional tie to the house. So this is where I raised my kids. This is, this house is fine for me for 30 years. How dare you say, that this needs to be replaced or that needs to be fixed? Because of the emotional connection, they'll kill the deal and say, no way. So it's kind of the same thing as that client not becoming your client. He killed the deal. He killed the concept of diversification because of his emotional tie to, the GM as a parent company.
Absolutely. And some of my favorite clients, it's an ongoing joke that I have with a couple who are clients of mine, and they have a beautiful house on the water. Mm-hmm. I mean, it's absolutely gorgeous, and it's worth over $1 million. Mm-hmm. And he wants to sell it, and she doesn't. Uh-huh. And so it's an ongoing joke. As soon as they come into my office and sit down, she puts her hand up and says, "Don't even talk about the house. I don't want to hear it." Because, her kids grew up there. Yep. And now her grandkids come down there, and they have jet skis and everything else for the grandkids to entice them to come more often. Right. And, she's not ready to move to a retirement community just yet. Right.
And it points out that you can understand where that emotion comes from. We're all human beings, and we have emotions like that, but it also points out that emotion can get in the way of you being a truly logical investor. Sure. And she's probably aware of, especially after Hurricane Sandy, the risks in owning oceanfront property, and the housing market is, it's a sector in and of itself. Things can go down in value within the housing market. And yet the emotion overrides those, understanding of those logical issues the same way it did for your GM guy. Well, logically, the husband wants to sell the house because a house on the water, especially on the bay, is very expensive to upkeep, high taxes. And then Hurricane Sandy didn't affect them too much. Their house is kind of high up, but they did have to do some repairs, and they did have a dock to repair and everything. So, and it probably affected property values in the general area. Absolutely, yeah. So. But talking about yield and return, that's one of the things that somebody came to see me recently about. Gentleman had a lot of high dividend paying stocks, and he was upset because his account dropped so much. He was with another financial advisor, but I told him, you're in high dividend paying stocks, so you're going to get a nice yield, but that doesn't mean, and you have to calculate, is it worth it? Right. I was talking with another client, and I said, when you're looking at a bond, you really have to calculate the yield to maturity. Don't look at the current yield, especially if you're buying the bond on the secondary market where you're paying more than par. Mm-hmm. Because when the bond comes due, you're going to get back par. So if you're buying the bond for more than par, you have to subtract that from the yield that you're going to make over time. So some of these bonds might be paying what looks to be an excellent yield right now. When you figure out the yield to maturity, it's not that great, right? And so people need to take that into account, and I don't think sometimes that's explained to people the way it should be. But the difference between yield and return, if a stock is worth $100 today and pays an annual dividend of $250,
that's a dividend yield of 2.5%. So the dividend is divided by the price.
Mm-hmm.
And that's how you calculate what the dividend yield is. If a stock price rises by 5% during the course of the year, that increase must be added to the dividend to give you a total return of 7.5%.
Mm-hmm.
Okay. Conversely, though, what happens if the stock drops $5?
Mm-hmm.
That has to be subtracted from the yield of 2.5%. You
Right.
know, and so what you bought for $100 loses $5, but made $2.50 in dividend. Well, you still lost $2.50.
Right.
So, so that has to be taken into account, and so investments such as bank CDs and money markets, there's really no difference between the yield and return because the price of the principal of the investment doesn't fluctuate
Doesn't change.
like it does with a bond or with stock.
Which is, I think, a component of why people don't understand this concept. They get used to, or maybe, especially some of my senior clients in their 80s or 90s, you use the example of when Carter was president. They remember the days where you could invest in CDs. You didn't almost have to dabble into the stock market if you didn't want to because the rate of return in the CD world. And so they're used to focusing on that yield number as being the most important number. I still have, even in today's CD world where the yields aren't very big at all, I still have clients that they go out and they comparison shop tenths of a point or hundredths of a point on CDs from bank to bank because they're so focused on CDs and the yield concept. But then they get into the stock market, they get into different investment classes, and they continue to look at the yield and they ignore the return component.
Well, that's what's happening, more and more now because, in my opinion, I could be wrong, but I think that the federal government has for many years now artificially kept interest rates low in order to try to stimulate our economy.
Mm-hmm.
And because of that, seniors who don't want to take risk are being forced to take more risk than what they may be comfortable with.
Mm-hmm.
They're very comfortable with a CD with a certain fixed percentage rate, and they can sleep at night. And that's the whole thing. I mean, you want to be able to sleep at night.
Right.
But people are now being forced to go into bonds that will fluctuate in the market and being forced to go into stocks. So they need to understand really what their risk tolerance is. And what's unique is we have software, and it's called Riskalyze, and we can actually go through a questionnaire with clients. It's 3 or 4 questions, very short questionnaire, maybe 5 questions at most. And we can tell somebody on a scale of between 0 and 100 exactly what their risk score is, and then build a portfolio to that risk score. So somebody with a low risk score may come out as, say, a 25 on the risk scale. Then we can build a portfolio using different investments, different asset classes to an investment score of a 25. Or somebody who has a risk score similar to what the market is. The S&P 500 will typically have a risk score of 80. And what people need to understand is if their risk score is 30, their return isn't going to be the same as the 80.
Right.
So that's something that's important to remember. Because sometimes people forget, well, my portfolio, is much more conservatively invested than the S&P 500, which is 100% stock.
Right.
So my portfolio is much more conservatively invested than that. But then I'm going to compare my returns to the S&P 500. Well, that's not really a fair
comparison. Yeah,
not a fair comparison at all. So
I want to remind everybody you're listening live to Inside the Law here on WOBM AM, which is 1160 in Ocean County and 1310 AM in Monmouth County. Today's subject is investing in stocks, and we have Chad White from Safe Harbor Wealth Management here as our guest. If you want to get in touch with Chad during the week, you can check out Safe Harbor's website at safeharborwm.com. That WM as in wealthmanagement.com. Or give him a ring at 732-364-2045. If you want to get in touch with us at the Novy & Associates Law Firm, our number is 732-657-0600. We also have a great website, which is novylaw.com. That's N-O-V-Y law.com. And it's great for both looking up information about our firm, the types of law that we practice, as well as looking at past shows that we've done here on Inside the Law, which we catalog and make available to the public through the website, including a number of shows where Chad's been our guest. Chad's always a great guest on the radio, and a great team partner for us in the business world. And so I encourage you to look up some of those past shows. A great wealth of free information, just a really good source. And, if it's free, it's for me. That's the saying goes. We also do a lot of speaking engagements and seminars out there. So check out our website for the upcoming, calendar of those speaking engagements. We have a couple in November, one at the Manalapan Library that I'm going to be doing about aging in place, and one at the Regency Group, Caregiver Regency Group, that Mr. Novy is going to be doing on estate planning. Those are November 18th and November 20th. So if you're interested in any of those subjects, check out our website on those. And if you have any questions that you don't feel comfortable asking on the air today, well, actually, if you have ones that you feel comfortable asking on the air today, give us a ring at 732-505-1160. Again, 732-505-1160. Or off the air, you can give us a ring at those phone numbers I gave a second ago. Or you can send an email to us at Novy & Associates, and it's just a very simple email address, info@novylaw.com. And every once in a while, we get such a good question that it becomes the topic of a show for us in the future. And if that happens, we will read your question on air. You can be in the running for a gift certificate to a local Monmouth or Ocean County restaurant. So give us a ring or an email if you have any questions like that or any ideas for shows. We're happy to field them. That's part of the reason we want to keep the program and the show pertinent to what everybody's interested out there in today's world. And I know stocks are one of them, which is why today's subject is such a good piece of topic matter to discuss. But anything else you think of, let us know. So let's talk about dollar cost averaging, Chad, because it ties into a little bit of what we were talking about before with emotion. The problem with Joe Schmo investor may be that they can't take the swings in the stock market, so to speak. And I've heard you and I've heard other financial advisors talk about, the human instinct is if things are crashing, or not crashing, is probably the wrong word. If an investment isn't doing well and it's going down, the human instinct is to try to get out of it. And when an investment has done well, the human instinct is to try to flock to it. And give me an idea of why that's a bad idea and how dollar cost averaging might work to mitigate that emotion or to counterbalance it, maybe.
Well, dollar cost averaging can be used in a couple of different ways. Most people are familiar with it if they've had a job and they've had a 401k or a 403b or a defined contribution plan or a deferred compensation plan, and they contribute money directly out of their check every month. So every month they're dollar cost averaging. They're buying sometimes when shares are high, and they're buying other times when shares are low. And the concept is that hopefully, when they're buying when shares are low, they're buying more shares. And so hopefully over time, the math usually adds up that they will pay a lower price over time. It doesn't always work, but usually over time they will. But the other important thing that it does is it takes emotion out of the equation.
Right.
And so you're just buying when, at all different times. And that's a good thing. But we talked about reverse dollar cost averaging in retirement, where we're not adding money to our accounts every month, but we're taking money out every month to live on.
Right.
And that's dollar cost averaging in reverse. And how dramatically that can affect a portfolio. And so sometimes in retirement, we need to have some type of a risk management strategy. because if we don't and we allow our portfolio, in the article that I just wrote, there was a quote I put in there from the Journal of Financial Planning that said that in the 2008 financial crisis, there were plenty of portfolios that were 60% stock, 40% bonds, which is a typical portfolio,
right,
that lost 30%.
Right.
Well, if you have that and you hold that through the entire downturn, you are going to lose 30% of your portfolio, and you don't need to make 43% to get back to even, because if you're retired and you're taking a withdrawal every month and you're taking a 4% withdrawal each year, you need to make 63% to
right.
get back to even. So,
and keeping in mind, sometimes you're forced to take that withdrawal under penalties of pretty burdensome IRS taxes if you're in certain types of qualified plans.
Absolutely. If you're over age 70 and a half, you need to take required minimum distributions from your IRA. And a lot of my clients take them once a year. They'll tend to take it in November, right before Christmas. If it's a smaller account, they'll tend to take it once a year. If it's a larger account, a very large IRA, or 401k, we'll roll the 401k out of their old company into an IRA, and then they'll take distributions on a monthly basis, usually if it's a large account, and use that to help with living expenses. And that's what people have to do now. They basically have to take their 401k and turn it into a pension that's going to last for the rest of their life. And so you really don't want to have a situation where you lose 30% of the account value, especially while you're drawing out money, because it's very hard to recover from, as many people found out through the 2008 downturn. And so what we do for clients is people will come in, sit down, have an appointment with us, and we offer a complimentary consultation the first time people come in. And we run their portfolio through software that we have that's called Riskalyze, which is software that was developed by an LPL financial advisor. And we can literally, once we enter their portfolio into the software, we can click one button, and the button says stress test, and we can stress test their portfolio. It will give us a risk score on their portfolio, and we can show them how risky their portfolio is compared to, say, the S&P, or compared to bonds, or compared to a 60-40, a typical 60-40 model, or a 40-60 model. And then we have a questionnaire associated with that software where we can determine, by asking the client questions about risk and about how comfortable they are with risk, specifically designed and geared on their portfolio, and then we can do the stress test, and we can let them know, well, if we go through another 2008 scenario, here's how much your account's going to be down. And they can decide whether they're okay with that, or they want to make their portfolio less risky. But it's a very good insight to have, and to be able to do that for people, because some people have no idea how risky their portfolio is.
Sure.
And they don't find out until it's too late.
Right.
And we want to help them try and avoid that.
And I want our listening audience to focus on that for altruistic reasons, as well as, for the type of law we practice becomes, to some extent, I don't want to say useless, but is really, if you don't make plans, if you don't make use of a free consultation with Safe Harbor Wealth Management, then there's no estate to plan for in some situations. So the front component of doing estate planning, they're different. Financial planning and estate planning are oftentimes considered separate, but to me they're like peanut butter and jelly, because one without the other is almost useless. So I like an educated customer client who knows what's going on with their portfolio, has assessed their risk, has a plan in place, because then if they've done their job and sought help from you, Chad, and from Safe Harbor, then there's an estate to preserve. If you've done the planning the right way, you've mitigated the risk, you've made it through your retirement years, and there's an estate, something left for children or for other family members. So to me, it's part of the conversation, and professional licensing laws prevent you from practicing law and me from being a financial a professional giving advice. So we've got to work as a team on these things, and doing one without the other is really somewhat pointless, in my opinion.
I always believe in bringing professionals in. People have tax questions for me, and I'm not a CPA. I'm not a tax advisor. So, I get a CPA involved if we need to. The same thing with estate planning. People have questions about wills, trusts, powers of attorney, medical directives, and I will refer those people out to attorneys because I'm not an attorney. I'm not an estate expert. But certainly those things go hand in hand. So what we like to do is be in the loop and work hand in hand with the CPA, with the attorneys, and have a cohesive plan for clients, not just be haphazard.
Right. Now, I want to put you on the spot with our last couple minutes here, Chad, because it just occurred to me a couple of times this week I've had, and even more so over the last couple of months, I've had a response from clients that made me uncomfortable, and I want to know how you would answer this. The basic way it went was they showed me an asset, spreadsheet, and I said, well, who's your financial advisor? I tried to get some information from them, and they respond to me, I don't believe in financial advisors. I had one once, and my account when I left him was $13,000 lower than when I brought it to him. And they didn't tell me when or how that happened, But if somebody says, I don't believe in financial advisors, what's the best response? I mean, there's some people you can't convince, but why? To me, that's a very poorly held belief, probably an uneducated consumer. But how would you respond to, somebody saying something like that?
Well, some people don't. I mean, some people like to manage their own investments. They spend a considerable amount of time doing it. It's become their hobby. They read as much as they can, and they are educated on the subject. And for them, it may not make sense to hire a financial advisor. My best clients are typically people who are very well educated on investments, but they don't want to do it themselves. They want to enjoy their retirement. They don't want to read the Wall Street Journal every day. They don't want to follow their account daily and make changes as needed. Right. They want somebody else to do that. And, for 1% or 1.5%, it's worth it for them to let somebody else handle it.
A professional who can actively manage it and let them go do what they want to do with their day.
Well, the other thing too is when it's your own money, your emotions get involved.
Right.
And so having a professional do it, they're not as emotional about your account as you are, so they can make decisions detached from emotion. Which can help people. But usually most people don't have the type of software that we have because it's too expensive for one person to buy all that software. We use the Riskalyze software. We use other software to manage risk in portfolios, which is called Dorsey Wright, which is very expensive software. And that shows us the areas of the market that we do want to focus on. Yeah, we want to be diversified. But we don't want to be diversified.
Right, I got you.
We don't want to be so diversified that our portfolio doesn't perform well, because we can do that too. So what the software helps us do, the Dorsey Wright software, helps us to focus on the areas of the market that are doing well and avoid the areas of the market that are not doing well. Yes, we're still diversified, but we want to overweight a little bit the portfolios to the areas that are doing well in the market. We don't want to just have lackluster performance. We want to have outperformance.
And to be able to do that without emotion and to stick with a game plan, to stick with what either the software is suggesting or the risk profile or everything together, to stay with a dollar cost averaging strategy if that's what you're into and not get cold feet when the market's down. All those type of things are things that a professional can bring to the table. And your average do-it-yourselfer, there are very sophisticated people out there who are capable, but by and large, they don't have access to that software. They don't have the time it takes. They don't have the discipline maybe or the emotion. detachment.
I say to people, if I can't add 1.5% value to the relationship, then I shouldn't be in business.
Absolutely, absolutely. Well, Chad, it's been great having you on this morning. A great subject matter. We could probably do 4 or 5 shows on stocks, if we wanted to, because it's such a broad subject. I wanted to make sure that everybody out there, again, knows to check out novylaw.com and safeharborwm.com if they have any follow-up questions that they have for us. And otherwise, thank you for listening today to Inside the Law on WOBM 1160 in Ocean County, 1310 a.m. in Monmouth County. Happy Halloween to everybody out there. Hope you got your costumes ready to go. I know that in our house that's been a big deal. Hope everybody enjoyed Back to the Future Day this week. I'm a big fan of that movie. And after this week, everything in Back to the Future will be in the past. So I thought that was funny. And I, of course, want to go against the flow. I'm a Jersey boy, but I went to Ohio State Law School. So tonight in Piscataway, I'll be rooting on my Ohio State Buckeyes against the Rutgers Scarlet Knights. I know I'm in the minority on that one in this state, but wanted to throw that plug in there. So thanks again for listening this morning. Have a happy weekend. You stay classy, New Jersey. Thanks for stopping by.